Today we're going to talk about capital gains and basis. So capital gains tax is the tax that you pay on realized gain from the sale of an appreciating asset when you sold the asset for more than what you paid for it. So if you, for example, if you own a piece of real estate or if you own stock and you originally purchased it for X and sell it for Y, that delta is the gain on that appreciating asset, in which case you may have to pay a capital gains tax, whether it be short-term capital gains or long-term capital gains. Now your basis in the property is what you purchase it for. So if you purchase a stock for $10 a share, that's your cost basis. If you purchase a piece of real estate for $200,000, that's your cost basis. Now, if you put in some capital improvements, that's going to increase your cost basis on the real estate. And when you inherit property from someone, you receive something called a step up in basis, which means the inherited property, the basis of the inherited property gets stepped up to fair market value on date of death. So your new cost basis is that date of death fair market value when that property is inherited. Let's take an example. Let's say your parents bought their property for $100,000 20 years ago, and now that property is worth $350,000. If they were to leave that property to you, your basis is stepped up to that fair market value on date of death. If you were to then immediately turn around and sell the property, if there is no gain, then there is no capital gains tax due. If you were to hold that property for a period of time and there was a gain, the initial gain is unrealized until you sell it. So there's no tax due until the gain is actually realized. Now, if you were to turn around and sell that property in a few years and it's worth $450,000, and let's assume for purposes of this scenario, it's not your primary residence, then you would pay a capital gains tax on the difference between what you sell it for and your original cost basis. One last thing to consider, if it's your primary residence you're selling and you have owned it and lived there for 2 of the previous 5 years, if you're single, you get a $250,000 exclusion on gain. If you're married, you get a $500,000 exclusion on gain. If you have any questions about this, please feel free to reach out.